Hey guys, I got a new setup now. I have a new webcam. Hopefully my microphone sounds good. So I think to celebrate, I'm gonna give away some tips on how to find out if the person you're listening to is a scammer or not legit as a trading guru. What are the top signs? How can you avoid losing money? And what can you learn from this video so that way you know how to spot a fake guru? Number one, the easiest way is if they're using their platform to get people to buy a mentorship or a course. It is 99.9% of the time a scam because these people cannot sell courses that have a value and it be public. Edges that are public degrade over time. Anyone that even uses their own strategy that has a positive edge, it will go down over time. One person using an edge is more than enough for that edge to slowly go away. Now, of course, you know, you can make the argument that they're selling it out of the goodness of their hearts. They want to help people, and I've heard that too quite a few times, but it still doesn't add up. If someone was trying to do it out of the goodness of their own heart, they would charge for free. They wouldn't charge you anything, and let's just say, oh, they have to make money. Then just do the strategy yourself. You don't have to charge anyone anything, and any money you can make, you just donate it. There's never a legitimate reason ever to sell a course related to a strategy or even trying to teach people how to trade because that would imply you're trying to teach them how they could make a positive return or alpha. Alpha is just positive return. So when people make these courses and they make these promises, 99.9% of the time, it's a scam. And there's a very simple reason why. If you do have a strategy that produces a positive alpha, depending on how liquid that market you're trading is, because some markets are infinitely more liquid than others, depending on how liquid that market is, you could be walking away with, if you finance it correctly, millions or billions of dollars. Some of the richest people on earth are super rich because they had a trading strategy that worked out really well and they were able to get investors who gave them money so that they would trade the strategy in exchange for them getting a cut as well. So for example, let's say I have a strategy that produces 10% alpha, which is 10% over the market risk adjusted, which is very good for any hedge fund typically. So let's just assume market average is 10%. So I'm doing 20 and I go to a bunch of investors and I raise $1 billion. Now in a year, let's say I make the 20%. So we end up with 1.2 billion. Of the 200 million that's made, I would keep 20% of the profits. So 200 million is the profit. So I would keep about 40 million there and I would get 2% on top. So I'd get another 2% of the 1 billion, which is 20 million. So I would get 60 million of that total and I would pay out about 140, 120 million to my investors, to the people who gave me money. So in exchange for them giving me $1 billion, they would get back about 12% on their money post expenses. And of course, there's like hurdle rates. In that example, I didn't have a hurdle rate. So they're typically like a hurdle rate. So you have to go over a certain amount of money before you're allowed to take fees. But just in that instance, it'll be the amount that you make, you'll get a cut plus a total. So it'll be the entire fund value, the $1 billion, you get 2%, and you'll get 20% of the profits, 20% of the money you made. But typically there's also a hurdle rate. So in this instance, if there was a hurdle rate, that might be to say the market rate. So I wouldn't make 20% of the 200 million, I would make 10% or 20% of the 10%. So split it, market would be 10%. What I made on top of that is 10% past that. So the hurdle rate would be at 10%, and everything I make over, I get a 20% cut. So in this instance, it would be 100 million over the 10% hurdle rate. I get 20% of that. So that's 20 mil plus 20 mil of the 2% total of the $1 billion. So you would make anywhere from 80 to $40 million in that instance if you were able to even generate 10% alpha in a year and you're able to convince investors, which is why all this stuff really is a scam and it's not impossible to raise money. It really isn't. If you have a strategy, you have your risk metrics all down and it's all correct, there's no reason why you shouldn't do it. Number two is that they are using ICT concepts, things like confluences, and they use words like order flow and all this stuff. This stuff is not real in the sense that it doesn't give you an advantage. ICT is not someone who's an actual trader. He made up a persona. He sat there and he lied to make money because he couldn't make it on Wall Street himself. And I know that's a hard pill for a lot of people to accept, but that is what it is. ICT is probably the biggest fraud in the entire trading space. The guy will sit there and, claim all of these concepts, none of which are real. They don't provide you any sort of a substantial advantage. They just seem like they might, and that's all they have to do. They just have to make it seem like, it's real. They have to just make it seem like it's something where there's some validity, but because the markets are random and ICT concepts are not very specific, you could end up seeing a lot of the ICT stuff even though it doesn't really exist if you were to look at it from a numerical perspective, because the chart will have some smoothness to it. So for example, if a chart say goes up or down, whatever, you could have two different charts in terms of the actual numerical values, but if you were to eyeball it on a chart, they look kind of the same, even though the values are different. So, for example, imagine there's this price of a stock and it goes 100, 103, 105, 107, and you have another one that goes 101, 106, 108. If you were to just look at those charts, they're going to look very similar. That's the part where people get fooled by ICT. They'll look at those charts and they'll think, well, they look similar, so maybe this ICT guy's saying something that's real, and they're just not. That's why it's number two, if just spotting a fake scammer, fake fraud. The trading space, gurus, all those guys, they use ICT concepts. None of these concepts are going to give you an advantage. They just simply cannot. And number three, they don't have proper statistics. Maybe there should be number one, but I'm putting it number three is they don't have proper statistics. A lot of them, you'll ask, hey, what's your ROI? How much alpha did you make? What are your Sharpe, what's your Sharpe ratio? These very, very simple, basic statistics that everyone who trades should know, and they're lost. It's like you told them, and can you pronounce me some sentence in Chinese, and they're staring at you like, wow, I don't know Chinese, I don't know what you're talking about, and they'll give like BS statistics. Win rate and RR are not statistics that are considered very important in high finance, which is what trading is. Trading is high finance. They're not considered very important because you just look at your expected value, your ROI. If your ROI is high, you're making returns over the benchmark and you have good risk adjusted metrics, why does your RR or win rate even matter? You could win 1% of the time, but make amazing returns. So it's really not dependent on those metrics. They don't know those things. The reason they don't know those things is because they don't track those things because they're not legit. And number four, they don't backtest properly. TradingView is not a proper backtest. It's just not. Unless you sit there and you program it with, say, Python, actual coding language, something like that, and you take your time, you program it, you backtest it, you feed 20, 30 years of data, you build that out, you reduce the noise, you do a bunch of robust testing, you do your 3-factor, 5-factor alpha models, all that stuff. And then you come back and you say, hey, now I have a strategy that works, it's tested, has positive alpha. They don't do that because they don't know what that is. Because if they did, they would realize there's no point to sell that. It's worth maybe millions of dollars, potentially, of course. But they're not aware of these things because that's not where they made their money. They made their money off convincing people that they're aware of these things and hoping people don't know any better. And number five, they give ridiculous returns. It is very evident someone is unaware of what they're doing when they say absurd things. Imagine someone says, hey, I'm a business owner. I'm my first year in and trying to give out a business seminar. You got to pay to join. And you ask them like, oh, cool. How much money did you business make in the first year? Oh, I made $15 million my first year in business. You're like, wait, what kind of a store do you like? What do you run? What kind of business? Like, well, it's a grocery store. It's a small little grocery store, but I made $15 million. I don't want to work for anyone else. And you're gonna sit there and you think, well, how is it possible that you made $15 million profit with a small little corner store or something like that? That doesn't make any sense. And these guys will sit there and they'll give insane numbers that even hedge funds are struggling to get. You have guys sitting here saying 60% a year. is anywhere near realistic, which it's not. Even 15, 20% a year by most professionals who work in trading and finance is considered unrealistic. It's considered to be rare that if you're able to do that consistently, you will be accepted into any financial institution with a very nice and high paying job, no questions asked. Yet I'm supposed to believe all of these guys, their batting averages is better than most hedge fund managers, better than those guys. I don't believe that. So those are the 5 tips that I have for today to spot a fake guru and not get scammed. Just keep those in mind, and thank you for watching.